Earlier this week, on Monday, August 5th, investors were freaking out. If you were on Twitter or YouTube, you saw the panic. The stock market was down, Bitcoin was down, everyone's talking about Japan all of a sudden. And meanwhile, here on the Wealth Potion channel, I broke down some of the dynamics at play, but most importantly, I cautioned investors from selling out of fear. And lo and behold, only a few days later, markets seem to be recovering. Bitcoin is back up 12%. The S&P has recovered almost 100 points. So are we out of the woods, or is there still some reason to be concerned? What's up everyone, this is Brandon from Wealth Potion, and today we're going to be discussing why the markets seem to have recovered very quickly. And we're going to do so by looking at two very important concepts in investing and economics. The first is the VIX, and the second is the yield curve. The common theme here is that expectations have the power to drive entire markets. We will then talk about what I'm doing with my investments, and then finally we'll talk about what's next, or more importantly, what I'll be looking for over the next couple of weeks to give us a signal of what the rest of this year will look like and potentially 2025. So without further ado, let's dive in. So first and foremost, we have to talk about the recovery. Firstly, did we even recover really? Now, from a short-term price action perspective, in many ways we have. As I mentioned, the S&P has started to recover. Bitcoin and crypto has recovered very, very quickly. And if we look at something like the VIX, which I'm going to dive into in a moment, it spiked all the way up to 55 and now is back down in the 20s. And I think the VIX is actually a perfect example to show where we're at in this crash/recovery kind of story over the past week. For those that aren't familiar, the VIX is a measure of stock market volatility. More specifically, it's measured by looking at the prices of options. I'm not going to fully cover options today, but in short, call options and put options are two types of investment vehicles that investors can purchase or sell when they want to bet on the stock market going up or going down. Now, just like any other economic good, there is supply and demand for these options. So when demand is really, really high for these options, the price tends to go up, and more importantly, the range of prices for these options goes up. To phrase that a little bit differently, when investors think there's going to be a lot of volatility in the market, they're going to be buying options to bet on that volatility, either the stock market going up or the stock market going down. And so the VIX, what it does is it looks at those price ranges across several options all across the S&P 500 and determines what are investors' expectations of volatility. And again, this is the theme from today's video. Expectations can drive markets. So when investors expect there to be volatility, we will see the VIX spike up. And when the VIX spikes up, a lot of investors start to get scared. Here's a real tangible example from history. On Monday, when everyone was panicking, the VIX spiked to its third highest level in history. The first two highest levels were the great financial crisis of 2008 and the COVID pandemic of 2020. So it puts in perspective when the VIX spikes, it's because investors are oftentimes scared of some big volatile event that's going to hit the markets. That is what happened on Monday. The VIX spiked up to about 55. As mentioned, it's now back down in the 20s as of recording this, but it's another good way to explain that we might not be out of the woods yet, because prior to the events of last week, when the Fed didn't cut rates and the Bank of Japan hiked their rates and everything we touched on in the last video, the VIX was in the low teens. It was hovering around 12 to 14, which means that investors were not expecting a lot of volatility. So while the VIX has recovered and come back down to somewhat normal levels, we're not fully in the norm just yet. We're not fully out of the woods, or at least that's what the VIX is telling us. So that's the first concept I wanted to cover, which is the VIX, which is, again, just one example, but I think a very clear example of how expectations have the power to drive markets. Now let's dive a little bit deeper into expectations. We're going to touch on a somewhat complicated topic called the yield curve. Now I'm going to do my best to explain the yield curve in very simple terms, but if you watch this video and you don't fully understand it yet, that is completely fine. And the reason I'm sharing this is because it took me a while to fully understand the yield curve. It is not something that is super intuitive because it touches on a lot of different concepts around how bonds work, how interest rates are inversely correlated to price. There's a lot of counterintuitive concepts within the yield curve. That being said, the yield curve is an incredibly powerful tool for understanding the economy. Imagine for a moment you had a single graph that could summarize investors' expectations for the broad economy. That's essentially what the yield curve is. And so, as mentioned, I'm going to do my best to explain it simply, but don't worry if you don't fully understand it. And if you have more questions, please do post them in the comments. I will likely do more videos on the yield curve in the future, and so I want to make sure that this concept is fully understood by everyone watching. First, we need to talk about bonds, and put really simply, bonds are another way of thinking about a loan. So let's say you want to borrow $1,000 from me, and I want to loan $1,000 to you. I could buy a bond from you, and basically imagine the exchange here. I give you $1,000, and then I get a piece of paper or a certificate, in other words, a bond, that says that you will pay me back that $1,000 at some certain time with some certain interest rate. And those two variables are very important. Every bond has a duration of time and a coupon rate, or in other words, an interest rate. So if you wanted to borrow $1,000 from me for a year, the duration would be 1 year, and let's say the coupon rate is 5%. So I buy the bond, and then after a year, you would pay me back $1,000 plus $50 for the 5% coupon. Quick sidebar, coupons are often settled semi-annually or twice a year. That's not super important for today's video. What's important is that there is a interest rate on that bond, because to lend you that money, I expect some payment for the risk that I'm taking by lending you money. Now let's say you want to borrow $1,000 but for 10 years. You would imagine that I would expect a higher interest rate because I'm taking on more risk by giving you money for a longer period of time. So maybe for a 10-year bond, I expect a 6% coupon rate. Again, the coupon rate would be every year. So every year I get $60 from you. Now we have to talk about the duration of bonds. Bonds come in a variety of durations. Most notably, there are short-term bonds, which are 3-month, 6-month, and 12-month, or 1 year. We have medium-term bonds, or intermediate-term bonds, which are 2-year, 3-year, 5-year, and 7-year. And then we have long-term bonds, which are 10-year, 20-year, and 30-year bonds. Now we can imagine a graph where on the x-axis we plot every single duration of bonds, and then on the y-axis we plot the coupon rate or the interest rate. As we touched on in our example earlier, you would imagine that as we go further out in duration, that investors would expect a higher interest rate on their loans. That is what we call the yield curve. And so you can imagine a curve that would have this kind of healthy slope up and to the right. However, this is not always the case. Sometimes the yield curve inverts. In other words, long-term investors expect a lower interest rate on their bonds than the short-term investors. And this is, again, where it's going to take some time for your brains to really grok this, or at least it did for me. If you're anything like me, it'll take you some time to understand this, but that is what an inverted yield curve is. It's where the curve bends negatively, and you might be thinking, that's completely counterintuitive. Why would someone expect a lower interest rate when lending money for a longer period of time? And there's a lot of reasons for this, but it boils down to expectations, because investors are expecting the economy to get worse, or inflation to go up, or for the Federal Reserve to lower the benchmark rate, which is a topic we covered in our last video. Basically, it's all about expectations. And when the yield curve inverts, historically that precedes a recession. But there's something else that happens with the yield curve that even more accurately predicts recessions, which is the yield curve uninverting. Now we're getting into a bit of complicated territory here, so let me recap. We have a yield curve that generally should be healthy. When it inverts, that can signal that investors expect the economy to get worse in some fashion. The yield curve in the United States has been inverted for over a year now. It's the longest the yield curve has been inverted since the Great Depression in the 1920s and 1930s. When the yield curve inverts, it eventually has to uninvert. Just this week, on Monday, that is also what happened. The yield curve uninverted. There's a lot to cover in that, but it can be best explained with this chart because, as I mentioned, the inverted yield curve predicts recessions, and usually when the yield curve uninverts, as in it goes back to normal, that tells us that the recession is coming very soon. Now, quick disclaimer here, I do not claim to have a crystal ball. I am not here saying that we're definitely going to enter a recession or a depression. I love this great saying. I think it's attributed to Voltaire, but history doesn't repeat, but it often rhymes. And so we want to look at history, we want to look at these trends and take lessons from it, but we have to be very careful not to predict that a recession is guaranteed. Now, that being said, I think it is quite prudent right now for investors to look at this short-term recovery as a potential opportunity to de-risk their portfolios. And this takes me to this final concept. It's a fairly simple concept, but I really want to touch on it, which is healthy corrections. You may have heard of the concept of a bubble before, a stock market bubble or the crypto bubble or what have you. And generally what people mean by that is that there is irrational exuberance for the price of an asset. The stock market is going up so much that it's unsustainable, or Nvidia stock is going up so much that it's unsustainable. And oftentimes what signals a healthy market is a correction. In other words, the stock market comes down or Nvidia comes down to relieve some of that pressure. What do I mean by pressure? Well, it can be a lot of things, but generally when investors get overly confident, they might start using leverage, they might start buying options, they're going to start going all in because everything's going up. And it's those investors that are taking the most risk, that are using the most leverage, that get wiped out, and the market can then return to its normal, slow, and steady climb. The reason I bring that up is because I think a very healthy frame of mind during these kind of flash crashes is to think of it as a healthy correction. In my last video, I shared that there were 3 things that I was looking out for in the coming days and weeks to better understand what was going to happen on the longer term. The first one was further comments from the Bank of Japan, and I used the example of if they further hike rates or they further tighten, that would be a bad sign. Well, the opposite kind of happened, where the Bank of Japan just came out and said, oops, sorry, we're not going to do that again for a little bit of time. And while we don't know exactly what happens behind closed doors, I wouldn't be surprised if there were some backroom conversations between central banks to say, hey Japan, you almost broke the global economy, let's calm down with the rhetoric right now. So in short, the first bullet point, thumbs up, good sign. Japan has said, hey, we're not going to be doing that much anymore. The second thing I said was that I'll be looking for Janet Yellen's commentary, and she hasn't said anything. And this is related to the third thing that I was looking out for, which is a potential emergency meeting from the Fed. And now that things have calmed down, that is looking pretty unlikely. And coupled with the fact that Janet Yellen did not make any public statements, that all can be read and framed as this was just a healthy correction. There were traders and investors and speculators that were over-leveraged, that were maybe too bought into this yen carry trade that got wiped out. And quite frankly, the Fed and the rest of the market looked at that and said, you know what, this isn't that big of a systemic risk. And so we really don't need to intervene right now. We do not need to provide commentary. In short, based on those things that I was looking for, I feel more confident saying that this crash that everyone is freaking out about is not upon us just yet. And I say just yet for a few reasons. As I mentioned, one, the yield curve is showing that we're going to get a recession at some point. And while that's not guaranteed, it might not even happen this year, it might not happen for a couple of years, that's what the yield curve is telling us. I've mentioned before, I'm going to be doing more videos on the central banking system. One of the blessings and curses of the central banking system is that they can influence the economy and the stock market just enough to kick the can down the road, but they can't prevent what will ultimately happen. And so while, again, I would caution timing the market and selling all your stocks or selling all your investments, I will share what I'm doing, which is as things recover over the coming days and weeks, which I think will happen, I will be increasing my cash position. I will be looking at my stock portfolio, putting myself in the shoes of Brandon on Monday when things were down really bad, and looking at the stuff that I thought, oh shoot, I should have sold this earlier. I didn't sell it then because that would have been a terrible time to sell, but those are the things that I've bookmarked for the back of my head to potentially trim as things start to recover. Now, I want to update the list of things that I'm watching out for over the coming days and weeks. One of the bigger things that I'll be looking for is any trouble afoot in the credit markets. I'm not going to dive into that right now in this video because it's already a long video, but in short, the way many financial crises play out is similar to a domino set. If you ever played with dominoes, you kind of have dominoes falling and hitting more dominoes and causing a bigger effect. You may have seen this very funny meme format where it's, a guy knocking down a tiny domino that eventually works up to this giant domino. That is essentially how financial crises of very, very large scale happen. Some sort of domino falls and it knocks over bigger and bigger dominoes. And you could argue some of those dominoes have already started falling, the smaller ones, and arguably the next bigger domino that is standing in front of a lot of other dominoes is the credit markets. In other words, if banks start defaulting on loans, that's where things could get really messy. So any talk about credit defaults, again, I'm not going to cover it in full depth, but if you studied the 2008 financial crisis or if you watched the movie The Big Short, you're familiar with credit default swaps, which is a way that investors swap their default risk with other investors. That's a sign that when investors are betting on credit defaults, then that can be a really bad thing, because when someone defaults on their debt, that wipes out that money from the system, and that can cause a cascading effect all throughout the economy. That could stretch to Japan, to the US, to all over the globe. So anyways, I don't want to bore you with the details of that. It will likely be a video that I cover in more depth in the future, because credit is another one of those concepts that is really, really deep that, quite frankly, I will admit I don't fully understand the depths of it. And if you listen to financial analysts that have worked in credit for their entire careers, even they have differences of opinions on where things are headed and what the credit markets are saying. So it's a very complex topic, but it is a very important one because we ultimately live and breathe and operate on a credit-based financial system. So hopefully today's video left you with slightly more answers than questions, but I'll close off by saying that the purpose of my videos is not to answer everything. I want to educate you all on these concepts, but I think just as important in learning is asking more questions. While I do want to, of course, address questions like what is the yield curve and how do bonds work and what is the VIX, why is it spiking? Hopefully from these videos, you're also left with more questions that you can then study on your own or learn about in some other source, or that I can continue to create content on to further your knowledge and your expertise in finance. And that, I think, is a sign of a healthy mind and a life of learning. So anyways, that's it for today. As usual, leave me a comment if you have any questions or if you have any feedback on today's video, and I will see you next time.